Hey guys, just checking in. I'm putting an article together, as you've probably read, on consumer spending in America and the fact that the US consumer is really starting to drive the economy. We've seen spending tick up, and it's really been for a few reasons. Lower interest rates have resulted in lower levels of saving. There's been a very, very strong job market over here, and the move up in housing prices has also done a lot to increase the wealth effect. And right now I'm probably in the home of the most conspicuous spending you could probably want to see here on Rodeo Drive in Beverly Hills, California. And it's business as usual, and that's been very true for much of the high-end brands, but the results that we've seen from some of the other companies in the last reporting round have been really very mixed. Stocks like Under Armour have been stellar performers. We saw really, really strong numbers there, buoyed a lot by the footwear division of that particular business. Yet stocks like Kohl's on the other side of the equation have really struggled. So it's been quite polarized as far as retail is concerned. At the high end of the market, some of the brands just looking around here, Bulgari, we've got Cartier, Louis Vuitton, Prada, Chanel, Ralph Lauren, and the list goes on, have been largely immune to any kind of slowdown, as those brands tend to be. They appeal to a demographic that really doesn't feel the pinch during more troubled times. But looking more broadly within the economy, some of the areas that we've also seen is that massive disparity in wealth increase even further. And probably a really good example of that is in the wage scales that we've seen for people that are in the tipped industry. In other words, people that work in restaurants, busboys, waiters, waitresses, those sorts of roles, where the minimum wage is about $2.48 an hour, with the balance being made up from tips. Now, on this street here, $2.40 buys you about 5 minutes of parking time. So there's an enormous wealth disparity. It would seem, as always, the rich continue to get richer, and those other people simply getting left behind. And if we look at the investment space per se, the wealth gap between the rich and the poor certainly has expanded considerably. And the way that the investments are performing for the rich versus the poor have also done the same. People that have been invested in the property market in Australia or even here in the US have done very, very well over recent years, where we've had an incredibly strong market. And obviously there's talk of the end of the property market is nigh, and that's a conversation that's been played on and off for quite some time now. But equally the stock market, in fact, even with the recent pullback that we've seen in the equity markets, over the last period of time since GFC, certainly in the US, we've seen the market put on massive weight, yet so many investors are sitting very risk averse, sitting in cash, sitting in asset classes that they deem as being safe. Now, cash, for example, with cash rates the way they are at the moment, well, those cash rates aren't even covering inflation, so effectively you're going backward holding cash as an investment. Whereas if you've been invested in a real asset, be it property or the stock market, you've tended to fare rather well. And that comes down to having that horizon mindset. It's very easy to get caught up in trading the headlines and seeing billions wiped off here and there and markets capitulating. And it's very, very important at times to take a step back and really look at what's going on. And over a long period of time, markets continue to go up. Super is an area that many, many people are starting to struggle with, simply because they've got that transition to retirement. They've been perhaps not invested as well as they could be. And there's a big void in knowledge between, say, setting up your own self-managed super and then having the skills to manage it effectively. And that's a skill or a void that can be filled very easily with some education. Looking for the opportunity in the market, looking at retail and seeing where, for example, things are performing very, very well. Looking within the commodity space, which may well be out of favor for many, many investors, yet there are still opportunities to generate good, consistent cash flow from that. Just recently, a trade on ERY, which is an exchange-traded fund on crude oil. More crude oil falls, which we've been expecting to happen, the more money we make. So it's time to create a new ending to an old story. And just walking along this street and seeing what's going on, copious amounts of spending by the haves and the have-mores, there's a reason why these people have got cash, and that's because they've been exposed to real assets and they've made their decisions to stay in on a horizon mindset rather than get caught up in the noise of trying to trade headline to headline. Strong figures in the US, the housing market's there, the job market's been firm, consumer spending, which makes up, believe it or not, nearly 70% of the entire US economy, have all been robust. The question is, are you getting exposure to that with your investments? And if you're sitting in cash, the answer is simply not. So, it's all going on here. It's a nice, quiet Monday afternoon. but the cash registers are still ticking over. And that's exactly how you need to be looking at your investments. If you'd like us to cover something in more detail, perhaps a different theme or a different story, make sure you have your say, post it, share this, and let us know what you'd like to talk about, and we'll prepare more articles and more videos to help you along the way. Cheers now.